Welcome to Brookfield Perspectives, a podcast that explores the Brookfield ecosystem's role in creating sustainable wealth on a global scale. AI is everywhere, yet its exponential growth will require equally rapid development of digital infrastructure, like data centers and renewable power. How can governments, hyperscalers, and private capital work together to meet these needs? To dig into the task at hand, we're joined by Sikander Rashid, Global Head of AI Infrastructure, and Peter Thal Larsen, the Global Editor of Reuters Breakingviews. Here's their conversation.
I'm Peter Thal Larsen. I'm the Global Editor of Reuters Breakingviews.
My name is Sikander Rashid. I am the Head of AI Infrastructure for Brookfield.
So, Sikander, AI, it's a massive topic. There's a lot to talk about, but let's just zoom out a little bit to begin with. I mean, you can barely move these days without someone confronting you with a new AI application or some sort of tool that they've developed, or companies talking about what they're going to do with it. But I think what's interesting to me is this frenzy of activity is also a massive infrastructure challenge, which is where you come in. So talk to us just a little bit to begin with about how you think about the scale of that challenge and the activity.
Yeah, Peter, the way I think about this is over the last 250 years, the world has seen 6 general purpose technologies, including steam engines, electricity, semiconductor chips, and the internet. And there's 2 common themes across all of these general purpose technologies. The first is that they stimulated many industries, created millions of jobs, and led to enormous economic productivity gains. The second common theme is they're all capital intensive. So if you take electricity, for example, in the early 20th century, first half of the 20th century, electricity build-out required $500 billion. And you fast forward to the late 90s, early 2000s, the internet boom required investment of almost $800 billion into the fiber backbone.
$800 billion in those days.
Those days, exactly. And you fast forward to today, artificial intelligence is the next frontier. It is the next general purpose technology. And similar to the previous technologies, it will also require massive build out. And our estimates suggest that build-out will be north of $7 trillion in the next 10 years alone. So to your point, the capital needs will be immense. And our view is this is once-in-a-generation investment opportunity for digital infrastructure and power investors.
Yeah. Also, a once-in-a-generation investment challenge as well, just mobilizing that kind of capital. Just break that down a little bit, that $7 trillion, very roughly. How much of that is chips? How much of it is data centers? How does that work?
Yeah, so it's total capex encompassing the entire AI value chain. Data centers would be $2 trillion of the $7 trillion.
Right.
Behind the meter dedicated power is probably $500 billion or so. Chips or graphic processing units, GPUs, which are central to training as well as inference of AI, will probably be around $3.5 trillion. So half of the total capex is really chips. Mm-hmm. And then the remaining trillion is other strategic adjacencies, whether it's dedicated fiber build-out, liquid cooling technologies, and other capital partnerships with semiconductor chip manufacturer and design companies.
Before we dig into this, just tell me a bit about your background. How did you end up in this role and dealing with all this technology?
Yeah, look, I started my career after finishing a mathematics degree at the University of Waterloo. It's a technical school in Canada. Mm-hmm. And in university, I probably learned the mathematical foundations of what today is artificial intelligence. So that would include algebra, combinatorics, applied probability, and calculus. And I joined Brookfield 13 years ago. And over the last few years, I've led many of our global digital infrastructure initiatives. And today, I probably am focusing on 2 to 3 things. One is stitching together frameworks for sovereign governments, whether in Europe or Canada or select Asian countries, that entail the creation of local AI ecosystems and stitching together frameworks for hyperscalers and other technology firms that would allow them to hopefully reduce the cost of capital and help facilitate the build-out of the large-scale infrastructure required for the adoption of artificial intelligence technology.
So you talked about the hyperscalers, which is sort of the industry word for the big tech companies, basically. We hear a lot about what they're doing. I mean, that's a big focus in terms of AI, is what they're doing and what they're investing in and what they're spending. I mean, I think Microsoft, Alphabet, Amazon, and Meta will collectively spend $300 billion this year or something like that. But These are big, very profitable companies, and they're funding a lot of this out of their own cash flow or by borrowing. So where does a firm like Brookfield get involved in that? What role do you play in their investments?
Simply put, I would say technology firms are building the brain whilst Brookfield is building the body. And a brain cannot function without the body. The brain cannot communicate or articulate concepts or ideas without the body. Hyperscalers, to your point, their capital spend on compute and data centers has doubled in the last 5 years. Mm-hmm. It's almost touching $400 billion today.
Okay, so it's gone up by $100 billion since I last looked at it, which is, seems to be what's happening a lot at the moment.
Exactly, Peter. And I think there's a couple of things that sometimes get lost in these big numbers. $400 billion a year, no doubt, that's an enormous figure. Loss of capital, and oftentimes technology firms who are not supposed to be capital-intensive businesses get scrutinized for their capex needs. And where we come into the picture is we just want to build a backbone of AI infrastructure for these companies. We want to build the body which will allow them to put the brain to work.
So I like the brain-body analogy. So just explain that a little bit more. What are the components of the body that Brookfield is involved in building?
If you break down the AI value chain, Peter, it really is 4 things: land, power, data centers, and compute, or GPUs. We have been active across all of those categories. Today, we are one of the largest hyperscale data center developers in the world, predominantly in the Americas and Europe. We are also one of the largest private renewable power developers in the world. On the data center side, our pipeline is north of 10 gigawatts. We have funded a few compute companies through structured instruments. And a couple of years ago, we teamed up with Intel to build the first advanced semiconductor chip manufacturing facility in Arizona, the US. So the value chain is simple. It's comprised of 4 components, and we've been playing across all 4 of those components for the last several years, if not decades.
So just thinking about the financial challenge then, because this is enormous, right? I mean, I was looking at a recent Morgan Stanley report, but they were talking about just data centers, the requirement being $3 trillion over 4 years or something like that. And their assumption was half of that would be funded by the big tech companies, and basically the other half would have to come from firms like Brookfield and financial markets and so forth. So how do you assess those investments? There's an element here of, you're trying to sort of figure out where the world is going and what the future looks like. When you're trying to make a decision about a data center or a power source or something like that, what's the analysis that underpins that?
Well, there's generally 2 key principles, and we tend to follow, whether we're investing in a power asset, a data center asset, a compute asset, or a foundry for that matter. First is we want to make sure for any large-scale development, there's an offtake agreement with a highly credible investment-grade counterparty on the other side. Mm-hmm. And the second is in an absolute downside scenario, we get our money back and a minimum return on it. But as long as we follow those 2 principles, the addressable market is large enough for us to continue to deploy large-scale capital in the AI space and continue to be a dominant player.
So then just coming back to those numbers, $1.5 trillion, it's not all going to come from Brookfield. So how do you sort of see this capital coming together?
You're right, Brookfield alone will not be able to fund it all. This will require a combination of public markets as well as private markets. There will be need for creation of secondary market vehicles for stabilized data centers. We recently did that here in Europe through our portfolio company Data4, where we carved out a portfolio of 250 megawatts, which was highly long-term contracted, and sold it off to investors that have a different risk profile for those types of assets. In addition to that, of course, on the debt side, we will need the support of, or the sector for that matter, will need the support of the USPP market, CMBS market, ABS market, and as well as project finance market. And then the last source of capital or support rather will come from sovereign governments. There's a huge push towards ensuring security of data, sovereignty of compute for national security purposes, as well as economic productivity purposes. And that will probably require the federal and provincial or municipal governments to step in with some level of support.
Just want to talk about energy because that comes up a lot and it seems to be a really big challenge. I mean, clearly these data centers consume a lot of electricity. I think the International Energy Agency reckons electricity demand from data centers worldwide is going to double by 2030 to 945 terawatt hours. I mean, that is a huge amount of electricity. What are the big challenges you think that we face in terms of supplying that electricity and I guess making sure that we don't run out of power in other parts of the economy at the same time?
Yeah, look, there's a few challenges, right? I think the first thing I'd say, Peter, is capital will not be a constraint and power generation will not be a constraint. The real constraint will be, or the grid rather. The question then is, how do you solve the grid equation? So in the US, for context, the next 7 years, there is expected demand for data centers of 50 gigawatts, but only 20 gigawatts of the 50 gigawatts has already been identified, meaning only 20 of the 50 gigawatts has readily available grid capacity. So there's grid shortages for more than half of the expected demand. Now, the question is, how do you solve for that? I think there's two potential solutions, and we're seeing some of that play out already. One is interim power solution, whether it's fuel cells or combined combustion gas generators or another type of interim solution. And in fact, in the last 12 months alone, 3 gigawatts of interim power solutions have been announced in the US and Europe alone. And the second solution will probably become a long-term trend, which is take compute where the power source is. Historically, power was brought to the computing centers. Going forward, supercomputers will be taken to the power sources. Those are two ways to solve the grid problem.
Right. There is an issue there, isn't there, as I understand it. If you're training a model or something like that, you can do that anyway. You can build a data center in the middle of a Norwegian fjord or something and have the power locally and all that stuff. But if you and I are pinging a large language model or something with requests, then that needs to be reasonably close to where we are. And that sort of inference data center use is the challenge because in London, obviously, or New York or Paris or whatever, there's just less space to build those data centers and the power associated. So how are people going to solve that?
Yeah, you're absolutely right. Proximity of inference workloads will be of paramount significance because the reality is going forward, today, more than half of the demand in the US is training driven. However, a couple of years from now, our expectation is 75% of the demand will come from inference or applications, which to your point, require a closer proximity to the end user. I think what we're going to see is a lot of the training demand will get pushed out to the power sources. So whether it's Northern Europe, Finland, Norway, or Texas in the US for that matter, will probably end up consuming a lot of the training demand. The inference demand, which will be supplemented, as I mentioned earlier, through interim power solutions where grid just doesn't simply have the capacity, will support inference demand.
And just to be clear on that sort of interim power solution, that's literally like you put an energy source right next to the data center or something. Is that right?
That's right. Yeah. So there's been a few examples of interim power solutions being put at work in the US and Europe recently. As I mentioned, 3 gigawatts just in the last 12 months. But it is as simple as you articulated. It's just CCGT solution or a fuel cell solution located in close proximity to the data center itself.
Amazing. I want to get your view on the broad investment case, because there is a build it and they will come aspect to this. These investments are all being made in anticipation of use cases for this technology that maybe exist in sort of embryonic form, or in some cases don't really exist yet at all, and sort of an assumption that people will pay for this. And that's what the big tech firms are betting very heavily on. And obviously everybody else who's involved in this is betting on too. So you mentioned at the beginning there'd been various investment waves of new technologies. You mentioned electricity, and that's sort of the internet. I mean, my other favorite one is the railway boom in Victorian England in 1840, when everybody went nuts and built lots of railways. And those investment booms created infrastructure, which then later was used and became useful. But it didn't necessarily work out so well for the people who put up the capital initially. So is there a danger here that we just end up with way too many data centers for a period of time?
The risk of overestimating demand and missing the timing is real. Those are very important considerations. Mm-hmm. And the reality is the next phase of AI, at the moment, AI is really, as you and I use it, a chatbot. You ask the chatbot a question and you get a smart answer. Over the last 2 years, those answers have become more sophisticated. They've become smarter, which is great. At the same time, the next wave of AI, whether it's agentic AI, agents that hopefully will run our operations one day, or physical AI or robotics, those use cases are developing, but they haven't been executed on a large scale just yet. We're optimistic that they will be implemented ultimately. But today, as of right now, agentic AI and physical AI, for that matter, are still relatively in their infancies. But I would say, Peter, at the same time, what's different compared to, for example, the dot-com bubble, when $800 billion of capital were invested into fiber infrastructure and led to many bankruptcies, there's a few differences compared to the dot-com bubble. The first is, unlike the internet or the electricity for that matter, artificial intelligence is not a single vertical, really. It touches, or is expected to touch, every sector in the world: finance, healthcare, education, public sector, you name it. So it's much broader, the application, than just a single vertical. The second big difference, I would argue, is today we're seeing, in our business at least, offtakes on the other side. So we're not building speculatively. Last 2 years, or 3 years rather, both in our power business and our data center business, we have seen unprecedented demand for compute, for clean power, and it's all been driven by long-term take-or-pay contracts with highly credible investment-grade counterparties, both hyperscalers as well as the enterprises. The third big difference, I would argue, compared to the dot-com bubble is the results of the users of the technology. So though agentic AI and physical AI are in their infancy, there's no doubt about that. Just last week, you look at the results, Microsoft reported almost 20% jump in Azure revenues thanks to integration of AI into the Azure products. Meta, once again, the business model hasn't changed, their geographical footprint hasn't changed, but thanks to AI, they reported a 20% jump. And those are two of the companies with some of the highest CapEx needs. Meta spending $70 billion, Microsoft spending north of $80 billion. So the point is, history would suggest there is the potential for many to lose capital, but there's a few nuances here. We're watching all the risks, but there's a few nuances here that give us the confidence to continue to invest, especially the fact that we have offtake agreements on the other side.
Yeah, that's a good point. You're not laying a cable across the Atlantic in the hope that someone will then use it. Just before we sat down, we were talking a little bit about this concept of the Jevons paradox, which you raised, which has come up a few times. I know. I think Satya Nadella at Microsoft raised it and stuff in this context. Can you explain a bit, like, what is that and how does it fit into this whole discussion?
Jevons paradox is arguably the most important concept we need to grasp in the context of AI infrastructure. So not the technology itself, but also the build out of this artificial intelligence infrastructure. Jevons paradox, the concept, was coined by a British economist called William Stanley Jevons in 1865. And what he noticed was, as steam engines became more efficient, the demand for coal increased. It sounds counterintuitive at first glance, but what really means is over 20 to 30 year period, Mr. Jevons noticed that the demand for coal far exceeded his expectation because the demand for steam engines, as they became more efficient, increased exponentially. And honestly, you fast forward to the 20th century, we saw that with electricity as well. Over the last 70 years, the price of electricity on a per unit basis has decreased by 65%, whilst the demand for electricity has increased 15-fold. That's 15 times. And the population has not grown by 15 times. It's really been driven by the fact that as a resource becomes more efficient, the demand for it starts to increase. And that is what Satya Nadella was referencing when he first, on the back of DeepSeek, when the market was plummeting, he tweeted these two words, Jevons paradox. And today, I would say Jevons paradox is playing out right in front of us in a couple of ways. One is the cost of inference in the last 3 years alone has decreased by 99%. And it's still not cheap enough. I think it will continue to decrease, and that is very important for the adoption of the AI technology. And the second important component of Jevons paradox today is the cost of compute and the cost of capital itself. When you break down the AI value chain, interestingly, 60% of it is not data centers or power. It's capital needs to onshore chip manufacturing. It's capital needs of chip design companies for the benefit of their own customers. And it is GPUs or compute infrastructure itself. And it is very important that cost cost of capital for 60% of the AI value chain is decreased over time. And that is an area where we believe we can play a very important role through financial engineering and through our structuring capabilities. And if we do that in conjunction with the cost of technology coming down, I think that would only be positive for not just AI infrastructure, but also for the adoption of the AI technology itself.
Okay. You mentioned a couple of times, and at the beginning you talked about governments getting involved in this technology, wanting to have control of data centers, chips, you name it. Obviously, we've also got the US talking about imposing tariffs on imports of semiconductors, trying to bring manufacturing back onshore. There's potentially a sort of fragmentation going on, also with governments getting involved. How does that affect this growth? Because I guess economists would say this is potentially less efficient. You're going to get duplication and so forth. How do you see it?
I think there's a couple of trends unfolding here. So one, of course, as you mentioned, is geopolitics or tariffs. I would put tariffs in that category. And that is leading to countries wanting to onshore a lot of the capacity, whether it's chip manufacturing capacity or the compute itself. So onshoring of critical manufacturing, onshoring of critical resources, I would put compute in that category, is the first major driver here. The second driver is the sovereignty of data and the security of that data. And this is where the need to create local sovereign AI ecosystems is critical. And that is a fundamental thesis of ours and has been the backdrop to some of the announcements we have made, including the $20 billion announcement in France in partnership with the French government and a $10 billion announcement with the Swedish government. And there's a few more of these coming.
Nice. Okay. You're a neutral party in the sovereign contest then?
Yeah, look, as I said, we want to build the backbone, we want to build the body, and we want to build it for some of the largest tech firms in the world, and we want to build it for sovereign nations.
Just to wrap up, this is a very rapidly changing field. Things are moving incredibly quickly. While we've been sitting here, probably the value of OpenAI has gone up by another few $1 billion. What are the applications of the technology that you are most focused on and most excited by that are coming up?
Yeah, look, I would say, Peter, from a business standpoint, the area we are most excited about is a sovereign AI. And sovereign AI is really application of the technology in the public sector. In Western Europe, there's a huge opportunity to enhance productivity. Productivity has been an issue in many of these countries, including the UK, where you and I are based over the last few years. But artificial intelligence can really help with that. And sovereign AI as a business model for us basically entails building out integrated compute for the governments who want data security, data sovereignty. And that is really exciting because it requires large-scale capital and requires operators who can build and finance this large-scale compute. So that's, from a business standpoint, what's exciting. From the technology standpoint, I would say near term, we talked about chatbots having mesmerized us over the last 2.5 to 3 years. Next layer, agentic AI and physical AI is actually quite exciting, particularly agentic AI near term. And what that means is AI agents helping us with our tasks, making us more productive on a daily basis, and hopefully adding enormous levels of productivity as they are adopted more widely by enterprises and governments in the coming years. And we'll probably see enormous improvement in AI agent technology in the next 12 to 24 months. In medium term, I would say, in addition to physical AI or robotics, healthcare is an area that I am watching quite closely myself. Faster drug discovery, reduction of trial periods from multiple years to 12 months is really, really exciting, I would say, for the humanity in general, in addition to agentic AI and physical AI. Peter, what about you? You are quite well versed in the technology and the implications of it yourself. So what are you excited about?
I think that the healthcare thing you mentioned is interesting. And in some areas, that's arguably already where we've seen the most real advances. But that AlphaFold exercise that Google's DeepMind did, as I understand it, that's led to the development of drugs which either are or are in the process of entering into clinical trials. So that, to me, is more interesting than a chatbot that can write a limerick in the style of Taylor Swift or whatever it is. Personally, if these AI agents can come anywhere close to being something that can filter my emails and my Teams messages and my text messages and all the different forms of communication that I get pinged with on a daily basis, and basically say, well, okay, this one you need to know about now, that one you can ignore completely, that one you can deal with later on, that would be transformative. So if there is an AI assistant that can actually do that, then I will begin to believe in this stuff.
They're coming, and I cannot wait for one of those myself. But hopefully we'll see a lot of progress in that in the next 12 to 24 months.
All right, well, maybe we can come back and
then
see.
We'll reconvene at that
exactly,
point.
Yeah. It's great to talk to you, Sikander. Thanks very much.
Likewise, Peter. My pleasure.
This podcast is for educational and informational purposes only and does not constitute an offer to sell or a solicitation of an offer to buy any securities or related financial instruments offered or sponsored by Brookfield. The information and views discussed are subject to change without notice. Any investment involves significant risks, including loss of the entire investment.
Audiation.